Delhi studio is my colleague Sumita Kareer. Now, in what could have been described as the largest FDI in the Indian financial services sector, Japan's Mitsubishi UFJ Financial Group Inc. will acquire a minority stake of 20% non-bank lender Shriram Finance Limited. This investment is valued at 39,618 crore rupees, which amounts to around $4.4 billion. Now, this investment has signaled a strong confidence in India's lending and financial services sector fundamentals and future growth potential.
Absolutely. In fact, Shabani, economically, this deal showcases global confidence in India's dynamic financial services sector. But this deal is significant not just for the private economic and financial values. It also reimposes great faith in India-Japan relations and ties. We spoke to ex-chairman of Shriram Value Services, Arun Duggal, on what this acquisition essentially signifies and the larger story here. Let's listen into what he had to say to us earlier in the day today.
A financial services industry, as you know, is always requiring capital. And this injection of capital will position Shriram Finance for many, many years to come to continue to serve the small borrowers. We started by serving second-hand truck owners, and now it's expanded in many areas. So, in summary, a very important transaction, a very important new partnership with the Japanese. We want to have, or the group wants to have, very large capital base so that it can continue to expand and grow without any capital constraints. I think it's a highly respected group worldwide and one of the best partners to have in Japan. So I think Shriram Group has done the right thing by partnering. I think it will impact cost of funds favorably, but I cannot comment on how much.
All right, ladies and gentlemen, to discuss this big story today on the show tonight, we're now joined in by KK Mistry. He's a former VC and CEO of HDFC and independent director in several companies. Also joining along with Mr. Mistry is Mr. Manish Agarwal. He's a partner at Deloitte India. Thank you very much, Manish, for taking the time out and speaking to us here on ET Now. First things first, let's start with the basics first. What does this deal essentially mean for the financial services sector here in India? And does this repose investors' confidence in the India growth story, particularly from the Japanese geography?
You're wanting me to go first?
Mr. Agarwal, if you could...
yeah. Okay.
Yes.
Good evening. Good evening, and thanks for having me on your show. Good evening, Mr. Mistry as well. Good to have you along with. I think, if you just look at it as a larger theme, this is flowing from a very strong fundamental structural reforms and the growing economy. This is just sort of a clear signal to what the economic growth and the potential for where the investment in India overall is being reflective of this deal. Now, within that, the banking and financial services space, we have seen over the last, let's say, few quarters, what has been happening and is being driven by, the capital has always been needed in many more sectors in India. However, I think this is more being driven by a very enabling, facilitative regulatory framework, a growing sort of a middle class as well as a wealthy class as well. A lending norms becoming a little easy, and the growth from the overall economic standpoint and the investment standpoint needs that much of a large capital to serve the tier 2 and the tier 3 cities where we are seeing the more of a growth. So it's a mix and the signal of a very resilient growing economy. You are wanting to capture the size of that growth. The capital is required not just from a lending standpoint, but also to invest in IT, the technology, because that's where the faster growth and the nimble-footed lending can happen. So it's a mix of all that put together.
Keki Mistry, I'm coming to you now. If you also can share your thoughts on how significant is the Shriram deal from an India lending landscape.
Let me start with, first of all, saying that India is an extremely attractive destination for foreign capital. The growth story that we see in India, or the growth expectations in India, are going to be huge, are really very high. Which economy can show you 8.2% growth in a world today where everything is so very subdued? So obviously, India is a very attractive destination for foreign capital. Now, when you're looking at India as a growth opportunity, the one sector where everything passes through that sector is the financial sector. And therefore, the investment by MUFG, and MUFG we have dealt with from HDFC, and they are very, very good people to deal with. The investment by MUFG reflects the confidence that they have in the Indian financial system, both from a regulatory standpoint, and I must say Indian regulators have been very, very good, whether you look at RBI, SEBI, IRD, any one of them, or you look at the growth opportunity. So it's confidence in the growth opportunity in India and confidence in the regulatory system in India.
Absolutely, Mr. Mistry. This reposes faith in the India growth story, of course, not just from one geography, but very many geographies. But particularly talking about the regulatory aspect of this deal, how significant is the regulatory shift that you have seen that's been brought about by the RBI from limiting FDI in lending to now allowing large financial institutions to pick up material stake?
First of all, I think, as I said earlier, the financial system is extremely well regulated. In that regulated environment, RBI now has the confidence to let foreigners take a larger stake in Indian companies, whether it's in NBFCs or, as we've seen in a couple of cases, even in banks, which reflects the maturity and the confidence that the regulators have today in the systems that are there in place. So I don't think that from an Indian standpoint we should worry about it. I think foreign capital should be attracted because foreign capital can give the confidence to the rest of the world to look at investing in the Indian market.
Keki Mistry, I'm coming to you again. What does it do to competition in the lending ecosystem?
Look, I don't hold the view that it is going to make a massive amount of difference in terms of competition. I don't believe so personally. Shriram needed capital. If MUFG had not invested, in all probabilities they would have raised equity in the local market, in the domestic market, and given the reputation that the group has, given the growth opportunities in the financial sector, I'm sure they would have got that capital. So this reinforces the capital base. It gives them growth capital, and therefore they will definitely grow and try to grow at a faster pace. But I think the growth opportunities in India are so huge, and we are such a massively underpenetrated market that I don't think it means that other NBFCs will not be able to grow or their growth is going to slow down or anything of that sort.
Right, Mr. Mistry, let me ask you another question, and after that we'll probably go to Mr. Agarwal, for our next set of questions. And thank you very much, Mr. Agarwal, for patiently waiting for your turn. But Mr. Mistry, how do you view the valuation of 2x the book, and not just the valuation of this particular company, but are valuations overall in the Indian banking and financial space attractive for more such investments to come into the banking and NBFC space?
I'll tell you, if you look at the NBFC space, there are a variety of companies trading from 0.5 or 0.6 times book and going up all the way to 4.5 and 5 times book. If you look at the likes of Bajaj and you look at the likes of Chola, and for that matter, HDFC also used to trade at one point in time. So there is a distance, and Shriram, for whatever reason, was not trading at that 4 times or 4.5 or 5 times multiple, but it's a very strong group. It's a very reliable, steady, mature group. And in that sense, perhaps the MUFG felt that the valuation was fairly attractive from their point of view, and therefore they've invested capital in the NBF in the Shriram. They were looking at putting capital into the financial system in India. We are aware of that. And NBFCs probably give them better opportunity in terms of investing because there are no voting right restrictions and things like that. And therefore, perhaps that was a reason why they were more attracted to investing in a NBFC rather than in a bank. But that's my surmise.
Also, Mr. Mistry, you have a deep understanding of the Indian lending ecosystem. What happens to cost of borrowing and how quickly and how much can they optimize on this?
I mean, it does improve. Their borrowing ability will improve because the capital goes up. As the capital goes up, the debt-equity ratio will come down. As the debt-equity ratio comes down and the capital adequacy increases, obviously the rating would be as good as it can get. And that therefore means that their ability to raise money in the domestic market will obviously increase because if the debt equity ratio has come down, then they can increase debt, they can increase their borrowing, and therefore aim at a higher return on equity. What this does is when capital first comes into a financial institution, whether it's NBFC or a bank, it tends to shrink the capital, it tends to shrink the return on equity because the capital does not generate in return from day one. It generates return, but it needs time for the company to pick up in terms of borrowings, increasing their debt equity ratio again, and that then improves their return on equity. So temporarily, return on equity will come down slightly, but at the same time, the capital ratio will go up significantly, giving them an ability to leverage more.
Right, Mr. Mistry. In fact, well explained that aspect of this particular deal. This has been one of the biggest deals, the deal that has gotten record FDI into the country. And let me now come to you, Mr. Agarwal. Thank you very much once again for patiently waiting for your turn. Now, if we look at the banking and financial sector, this is the third largest deal. There was SMBC and Yes Bank, Avendus and Mizoho, MUFG, and Shriram Finance. But will corporate India be able to step up capex as such deals will lead to a consumption push? And there is an understanding, or there is perhaps an expectation that there will be more such deals in the future. But will private sector be able to sort of keep pushing a capex for that consumption push? Because remember, consumption push essentially happens beginning with the financial sector.
I think so, because if you really look at the private sector investments, I think over the last, let's say, 1.5 to 2 years, it does have moved up because previous to that, as you rightly said, the government has been spending the large part of the capex, whether in infrastructure or other sectors. However, in the last 1.5 to 2 years, that private capex has increased. If you see the large M&A ticket sizes, and if you specifically look at $1 billion plus deals, they have increased in sizes across the various sectors. And with the government providing more very focused incentives in specific sectors, now whether it is semicon, whether it is manufacturing, whether in the defense sector, I think the investment in private sector, I would say you are seeing in the select sectors. It's not probably spread across anything and everything because of the past experiences. I think the private sector, rightly so, is a little more cautious about where to spend the money. They have deleveraged their balance sheets. They are having a good earnings quarter as well. So, and with the government also allowing the M&A financing, which was here for restricted for the Indian banking system, I think the capital requirement has also increased along with the private pool, private capital or a private sector to make the large bets on the investment. So I do see that trend increasing. And that's why, these foreign banks, if you really look at in the last 2-3 years, it's not that the foreign banks were coming in such a horde as what you see in the last, let's say, 2 quarters. So there is a reason for that. There's an increase in the wealthy class. There's a larger corporatization and the industrial sort of an activity of the Indian large groups, which are becoming increasingly global. And you see the large corporates having very large GCCs in India. So they have to serve their customer base globally. they are wanting to cater to the Indian wealthy class, and they're wanting to cater to the Indian corporates as well. So it's a mix of all that, and that's why you see such a foreign capital and the foreign long-term banks capital coming to India.
Absolutely, Mr. Agarwal. And, Deloitte has also previously highlighted that India's liberal FDI policy as a major draw for investors to come in. Now, with the recent development of the FDI limit in the insurance sector at 100%, what specific innovative financing solutions, according to you, is Deloitte advising the clients to leverage on some of these changes, particularly in developing infrastructure and technology needed to achieve, let's say, something like insurance for all, in 2047?
I think three factors, the way we are looking at it. First of all, Deloitte has what we call as a Bharat sort of a initiative in the program. We strongly believe, our leadership strongly believe that the growth in India and the next decade of a growth, which is the Prime Minister's vision of 2047 and Viksit Bharat, is going to be beyond just metros. That's number one. And therefore, you are tapping up those sort of companies and the players, hand-holding them from the start so that they can write the economic story of India as well and grow themselves. If you really look at from the financing standpoint, as I said, I personally believe that the private credit is increasingly becoming a growth capital. Most of the entrepreneurs, as they're growing, they are deciding about which pool of capital works for them best. Our market regulator and the government has worked over the last 3-4 years, and therefore you see a lot of InvITs and the REITs coming in. Our capital markets are very beyond, and you are also looking at a number of sectors where, let's say, today you are in the X sector, and you see a growth opportunity in the many more adjacent sectors as well. So therefore, as Deloitte, we are looking at these beyond the metros, the entrepreneurs, the groups who can really grow very fast, leveraging the opportunities being thrown, the structural reforms that India has done, which is the fiscal discipline, a very facilitative regulator, I must say, that some of these banking financial services transactions cannot happen unless and until you see a very positive signal from the regulator. You are also seeing, as I said, about the innovative financing through M&A financing being allowed, the private credit being there, and the capital markets being very beyond. So we are at Deloitte looking at the multiple sort of sources of financing and advising our clients as to what capital requirement suits them best at what stage of your life cycle. So we are pretty much at the forefront in some of these structural solutions and the innovative structures as well.
Absolutely. Mr. Agarwal, this speaks volumes about the India growth story. And of course, we just heard this afternoon from India's Commerce Minister as well, since the fact that India has signed an FTA with Oman. He was telling us how, companies in Oman are looking at investing in some of the key sectors here in India. But let's talk back about this deal, and let's go back a little bit and talk about what we were essentially talking about, the MUFG Bank and this particular deal related to Shriram Finance. When we look at some of the investments that have been made by Japan, particularly with respect to that as a geography, it's been by Nippon Steel, there's been Suzuki Motor, also Toyota Kirloskar, Sumitomo Realty. So there's been some sort of an investment from Japan and from India into Japan. But what are some of the regulatory risks, especially when India decides to open up its sector and invites FDI into the country, particularly with respect to these financial institutions? Are there any risks that investors should be cautious of?
Look, I would say, two questions. I would say, look at Japanese corridor specifically. I think after our Honorable Prime Minister visit, as you know, they announced about $60 billion of an investment spread over the different sectors. We are seeing a large amount of interest on energy transition, where India has really turned the scale and the size and the nature of the opportunity as well. We are seeing in the defense sectors and then obviously the banking and financial services space. So it's being a very thought out strategy to my mind, rather than a knee-jerk sort of a reaction that you see today. On the second question that you asked about the guardrails, I think if you really look at 2 or 3 fundamental factors, what has happened in India over the last sort of 4 or 5 years, we have a strong guardrails. I think while we are opening up, at the same time, our financial system, I must say that the regulator, the government has done a great job. We survived financial crisis, we survived the COVID, and not just survived, we have actually almost back to the pre-COVID years as well in terms of economic growth. Now, just because you are seeing, look, again, to step back, corporates are not allowed in the banking system. Private equity is limited to a particular percentage. You need a lot of investment in the technology. There was a time when Indian sort of a private sector banks and within the domestic banks, you were seeing a lot of consolidation. But now the time is like the growth opportunity is very large, and therefore you need a foreign bank sort of a capital coming in, whether banks or financial services as a sector, and a lot of investment in the tech as well, on the digital and the security is part of it, right? So the regulator is being driven by, unlike the past mindset of being a micromanaging, it's a very strategic macro management. You put a strong guardrails, you took a strong sort of a monitoring mechanism in place. We have a capping of the voting rights as in the banking system. So I think we have put enough guardrails to answer your question, and we should not then worry about how the market dynamics sort of plays out. And if you really see the investments in this particular space, it's largely from the Middle East and the Japan corridor. And both are geopolitically pretty much, we are very well connected after the government has put, and the Prime Minister himself has put a lot of efforts to the two geographies as well. So I'm not very worried about that. Hello, Shivani, can you hear me?
Thank you very much, Mr. Misri and Mr. Agarwal, for taking the time out and speaking to us here on ET Now. This indeed is a very big deal. This is a big shot in the arm as far as India's FDI is concerned. And like you rightly stated, that there is investment that's coming in from the Middle East, UAE to be specific, and of course Japan, even as India tries to solidify its partnerships across the globe, and not just solidify those partnerships, but India is looking at increasingly bilateral deals vis-a-vis the deals that are driven by WTO.